Do you guys just remember a couple of weeks ago, Elon's 13F filing came out and the algorithms, the news wires, they picked up on this as Elon had acquired more Tesla stock when in fact he did not? Well, it just happened again. This Tesla stock breaking news came across multiple news wires that Tesla raises prices of the Model Y long range to $43,990 from $42,990 in the US, according to their website. As Sawyer Merritt clarifies, these price increases happened on March 1st, not today. The prices today are the same as they were on March 1st. Let me tell you, the uneducated media is probably going to post this as new information, as good news. After all, I didn't really hear mainstream media talking about Tesla raising prices on March 1st, so maybe that comes about now and could be a little bit of, I guess, fake good news. I suppose that's possible. But really, here in this video, we have more pressing measures to discuss. Two major events coming tomorrow morning that you need to know. These two events, one of which is CPI. I will go over the estimates from the market, some troubling signs that we have seen over the past, let's say, week or two in different asset classes that points to maybe a hotter than expected CPI report coming out tomorrow, and I think that's something we need to talk about. Number two is the SoftBank ARM lockup expiration. You can even see ARM fell 3.6% today, and as I'm looking at it right now here on the other monitor, it is down about 0.67% in after hours, dropping as much as 1%. There's some speculation here to how many shares SoftBank is going to sell. Some people think they may only sell a little bit. They might sell strategically, like every single day. And while that's possible, it's improbable. And the improbability of this means if SoftBank sells a good chunk of ARM, it's likely to send down ARM stock quite a bit, and likely to also send down NVIDIA and other AI semiconductor companies. Now, why is that potentially a problem? Well, if you don't know, I'll tell you, markets have been rallying off of momentum, not off of fundamentals. NVIDIA, ARM, SMCI, these other companies, sure, they're great companies, but since they reported earnings, a lot of them have gained 30 to 50%. Is that any new information come out? No. Analysts and investors, they're just going out longer to justify these companies' valuations. Instead of looking at 12-month forward PEs, which is typically standard, they're looking at 24, 36, 48 months down the line to try to justify where these stocks' valuations are currently at. That's because they've seen a lot of momentum. And let's be honest, if you are an analyst right now and you are bearish on semiconductors, not bearish on the industry, but just bearish on where the stocks are at and how much they've run, you're definitely not getting too much coverage. I'll tell you that. Financial media is not going to be talking about you too much because it's not going to get clicks because everyone is bullish. I'm here to tell you, I'm probably the most bullish individual on AI that you know out there. There's probably nobody that's more bullish than me. But semiconductor valuations, the stocks in the near term, yeah, it's not a very favorable place, if you will, to put this nicely, to invest your money. And I think there could be quite a bit of downside here. Now, this does have a direct correlation and effect to Tesla stock. And let me break that down in about 60 seconds. I've talked about this many times here on the channel, but ARM, NVIDIA, SMCI, Intel, Dell, all these companies that have done well, they've sucked money out of other areas of the markets. Apple, Google, Tesla, these stocks that are seen as AI losers. The money has left those stocks, went into NVIDIA, went into other areas of the markets. How we know this is because we know there's not a lot of inflows to our markets right now. Money is not piling into stocks. If anything, it's piling into money market funds, trying to get, 4.5%, 5% yield on their money, even into treasuries. It's not going into stocks. The equity risk premium is not very attractive right now. And basically what that means is if you put your money in stocks compared to bonds, when they yield you 5%, The earnings growth on the S&P is not that attractive. It's expected to be about 11%. If you can get 5% in a treasury, your risk reward looks optimal if you are in treasuries. Now, topic for another video. I get it. Point is, liquidity is very stretched in our markets, and it's been leaving areas of the markets like Tesla, Google, and Apple, because those companies have large market caps. So when you're seeing a $200, $300 billion market cap move on Nvidia to the upside or the downside in a single day, well, where do you think that money is coming from? It's coming from other large cap stocks, these quote unquote AI losers. Sure, it's coming from small and mid cap stocks as well, but those market caps are a lot smaller and there's not as much allocation to those stocks. So as you've seen today, Nvidia was down 2%, ARM was down 3.6%, other AI stocks and semiconductors were down, anywhere from 2 to 5% today. Well, what happened? Tesla stock was up 1.4% on very little good news. There's really not much news at all today on Tesla. One analyst with Canaccord Genuity did say Tesla is oversold and they're bullish on Tesla, whatever. But that's not 1.5% worthy news, in my personal opinion. What's really happening is when your AI stocks are seeing outflows, when those stocks are falling, that money is going elsewhere into other areas of the market. So momentum, falling out of favor with semiconductors is very well likely to be a positive catalyst for Tesla stock, as you are seeing here today. Even take ARM for an example here in after hours. ARM's now down 0.74%, heading into their lockup expiration, which is tomorrow, and Tesla stock is up almost 0.25% in after hours. I've been talking about this relationship between Tesla and AI stocks for a while now, and I think as of lately, you're actually starting to see this relationship a lot clearer. And I think today may have been an eye-opening moment for a lot of people that have been questioning my theory on this. I don't think it's a theory anymore. I think it's being proven. Now let's start with catalyst number one. Now I think CPI is probably more impactful to the broader markets, but I do think ARM is very impactful, this catalyst with ARM, to Tesla specifically. So we'll start with that. Again, think back to the relationship that we just went over. AI stocks fall, that could open up money to head back into Tesla, especially as Tesla is down roughly 30% year to date. So the situation with ARM, it's actually a lot simpler than people actually make it out to be. And I'll try to explain this as simply as possible and as quickly as possible. So SoftBank acquired ARM back in 2016 for $32 billion. They tried to sell ARM to Nvidia for $40 billion. That would be a net profit of about $8 billion. That was back in 2022. SoftBank instead took ARM public when the EU regulators said that Nvidia could not buy ARM. Okay, fine and dandy. Well, ARM did okay on earnings, did pretty well on earnings, and the stock went up big time. Keep in mind, the stock when it IPO'd was around $50 per share, $51 or so, and it actually fell after IPO. The IPO indeed flopped, as some people would say. So there wasn't a lot of demand for ARM, and then they beat on earnings. There was a ton of demand for ARM. Why ARM stock went up so much, 50 or so percent following earnings, 48% the day after earnings, went up 1.16% the day after, and then 29% the day after that. And that was the majority of kind of the gap up that we've seen, were those 3 really big days for ARM. The reason why that happened is because 90.5% of the float of ARM is owned by SoftBank and is unable to trade until tomorrow morning. So there's only been 94 million shares that have been trading hands on the open market right now. So there's a very low float, if you will, but there's actually not, because there's 1.03 billion shares outstanding. Just 94 million have been trading hands. So this is kind of like a company that did very well with a very low float in the specific sector that is popular right now, which is AI. Here's the problem. Some people think SoftBank is going to sell kind of ARM strategically, like every day sell a couple 100,000 shares. The math on that doesn't really make sense. A member in the trading community pointed out this article and what they had to say, and I'll actually shout him out right here. That is Lance, and I did provide my my take on that here, which I'll read in just a moment. Again, if you guys want to join that, check out the link down below in the description of this video, because we do have some puts on ARM. I do have a vested interest here as well that I will show you just for transparency's sake. Okay, now it says, will SoftBank open the floodgates? SoftBank currently owns over 90% of ARM shares outstanding. This is a Japanese tech conglomerate that took ARM private in 2016. It says investor focus will be on SoftBank's actions as the lockup period expires. The company is highly incentivized to protect the value of its massive ARM investment. A sudden offloading of a significant portion of its stake would likely increase the supply of ARM shares, potentially leading to downward pressure on the company's stock price. A more probable scenario is a gradual, measured approach to selling shares. This would allow SoftBank to maximize its returns while minimizing any negative impact on ARM stock's valuation. This is true. The best thing that SoftBank could do is slowly sell out of their ARM position. Here's the problem. The math really doesn't align with that, okay? Because if 10% of ARM's position in SoftBank is 92 million shares, just 10% of their position. If SoftBank were to sell 500,000 shares a day, it would take them 184 trading days to do so. There's only 250 to 252 trading days in a given year. So that's pretty close to about a year to sell 10% of their position. Now, you got to remember, these stocks are trading on momentum right now. So if that momentum goes away, if you start to see some of these stocks fall out of favor in the course of the next 184 days, well, SoftBank could take an even larger haircut on their position. Because let's be honest, SoftBank's ARM's PE right now is 1,834. That was higher than Tesla's PE ever was back in 2020 when they were just becoming profitable. That's insane. ARM's forward 12-month PE is 83.38. NVIDIA's forward PE is 35.5. So ARM is almost 3 times more expensive, dollar for dollar, cent for cent of EPS. I think that's pretty problematic in and of itself. But upon further kind of the mathematics of this, 500,000 shares a day is pretty substantial. If you take a look at ARM's volume today, ARM's volume was about 10 million. So that would be 5% of today's volume in selling pressure on ARM stock every single day for the next 184 days, just for SoftBank to sell 10% of their stake. I think odds are what you're going to see happen is a block of shares get sold. Maybe 5 million, maybe 10 million, who knows? SoftBank owns 929 million shares. Who knows how many shares get sold? But something will likely be sold tomorrow, and then you'll see slow selling. But if you are a bank, if you're a fund, it doesn't matter. Doesn't matter. If you have anyone with a fiduciary responsibility to make the best decisions you can with investor capital, like that's SoftBank's job, right? You can't invest or trade upon a logic that momentum will continue for an extended period of time. In other words, SoftBank cannot hold on to their position and not sell based on the logic that momentum will continue. That's not a very smart move. Now, it's also worth considering that SoftBank has made some very bad investments in the past. WeWork was their largest investment before ARM, and they lost $14 billion on that just recently when WeWork went bankrupt back in November. So that's pretty problematic as well. Now, also consider that ARM trading at $125.73 here in after hours, and consider SoftBank's position in this company. SoftBank has about $117 billion of value in their ARM position as of today. The entire market cap valuation of SoftBank is around $87 or so billion. So their ARM position's worth more than their entire company. If you look at SoftBank stock, it hasn't done well. Okay. Hasn't done well at all. And actually the market cap's about 88 billion. So I was about 1 billion off. It hasn't done well, right? The high back in 2021 was about $49 per share. The stock, even after their successful ARM investment, is $28 per share. Before that, it was regularly under $20 per share. So the company itself is not doing that great. And they've just had a lot of bad investments. And SoftBank's CEO, Masayoshi-san, I don't know really how to say that, the CEO and founder, he wants to create a $100 billion plus startup to rival NVIDIA's chips. Just from my experience in the investing world and in finance, you typically have to put up about 20% of whatever you're trying to raise up front just to show people you are serious. Imagine if you go to somebody and you're like, hey, I have this great idea. Will you give me $1 million? They're going to say, how much of your money are you investing into this? You're going to say, well, nothing. Good luck getting $1 million. Now, if you say, I'm putting up half, go half and half with me, that's a little different. Even if you're putting up 20%, that's a little different. Where is SoftBank going to get that much money? 20%, $20 billion. Odds are from their ARM position. If you want to just, kind of theorize, let's say SoftBank did sell $20 billion worth of their ARM position. Well, if their ARM position's worth about $116 billion or so, divide this by roughly 20%. That would be about $23 billion if they sold 20% of their position, essentially. So roughly, what would that look like? Well, divide that by the current share price of ARM, which is about $125.70 or so. That would be about 184 million shares. That's a problem when there's only 94 million shares trading hands right now. Now, are they going to sell that much tomorrow? Obviously not. Could they sell 10 million? Sure. Now, if there's only 94 million shares trading hands and they sell 10 million shares tomorrow, that's pretty much like a little over 10% dilution to the float outstanding now. Okay, the float is over 1 billion shares. The float that's trading now is 94 million. So if they sell 10 million, that's like 10% dilution. That's not going to look pretty for ARM stock coming tomorrow. So yeah, I do think this is very problematic. Even, again, consider the volume that we've seen today. 10 million shares. What would be selling slow to people, right? 500,000 shares a day relative to 929 million shares that SoftBank owns. That would be selling at a very slow pace. Just to sell 10%, it would take 184 days. To sell 100%, it would take like 7 or 8 trading years. Okay, that's a very slow pace. And I don't know how much more conservative you could really get here. Do they sell 200,000 shares a day? Okay, then it's going to take 20 years to sell out of your damn position. Just making up numbers here, but it would be a crazy long time. So I think they sell a block of shares tomorrow, probably 5-10 million shares, which let's see, how much money would that raise them specifically? If they sold 10 million shares, that would times the current share price, $125.70 or so. That would raise them about $1.25 billion. That's not a terrible, chunk of money to get right up front. Again, consider that SoftBank was willing to sell ARM to NVIDIA for an $8 billion net profit. Again, they bought the company for $32 billion in 2016, willing to sell it for $40 billion. If they sold 10 million shares tomorrow, that would net them, let's see, 8 billion, if I'm doing this math right, that would be about 15% of the total profit that they were looking at netting selling the company to NVIDIA in 2022. I mean, yeah, That makes sense. Could they sell more? They could sell more. ARM could be down 20-30% tomorrow. I don't think there's really a good outcome here. That's the problem. Now, I'm going to show you guys my position briefly, then we're going to move into CPI and my expectations for Tesla stock. Just for full transparency's sake, I want to let you guys know I'm saying this. I do have a vested interest in what I'm saying, but do not trade ARM options. They're pricing in a lot. I've been trading options for my entire adult life. Okay, I'm very experienced, know what I'm doing in this regard. If you want to join the trading community, then, all the power to you. That's always an option. And come learn, come get, involved in the community and how you trade options profitably, how you should trade options, okay, on a more speculative gambling, process. Remember, if you're trading options, you're gambling. There is no investing when it comes to options. Options were originally created to hedge your risk in long positions. They have morphed into a gambling instrument, okay? And I'm sure you've heard of Wall Street Bets. Go look on there sometimes. Look up Wall Street Bets greatest failures. People lose their whole life savings. You got to be careful and do not trade anything that you're especially about to see, but really just don't trade options in general. That's best advice for most people. And about 85% of options expire worthless. So statistically, the odds are against you anyways. Now, I've made these trades a while ago. I've been down on these trades. I'm still down on this trade. But I do think this is a good risk to reward for my personal, kind of strategy here. Now, I do have 35 April 19th, $70 puts. I like these a lot better, clearly. And then I do have ARM $55 puts, and I have 50 of them. These are very cheap. So what I'm looking for here is for ARM to fall, but I'm not expecting ARM to fall to 70 or to 55. I got an additional 5 weeks of time here, because when ARM does fall on the lockup period, people are going to say, oh crap, SoftBank has 90% of the float. If they're selling stock, they may not stop. They may drive this thing down to the ground. The fear will pick up. People will run to buy put protection, and traders will pile in. That has been my theory the entire time. Now, these ARM $70 puts, they just started doing a little bit better. I'm just up 22.28% on this position. My average cost is $26 per contract, and currently worth a little bit over $1,000 per share. The other puts are pretty much dead at this point compared to when I first put on that position. I bought these on February 29th, so I've held these for about 2 weeks already, and I've already averaged down. I accidentally sold 5 at $18, but they're going for about $30 on the bid. You could probably sell them for about $31, $32 right now, and on the ask is about $34. And then on the $55 puts, I've done a lot worse, down 52%. I've even averaged down on these a little bit. Bought these on February 23rd. I was expecting kind of a rundown into the lockup period, but it doesn't seem like anyone even considered the possibility that SoftBank would be selling anything. Now, let's go over CPI. I think CPI is pretty self-explanatory. I think a lot of you guys have been around for quite a few CPI reports by now. You've been around in the markets at least a couple of years, if not a very long time. CPI comes out tomorrow at 8:30 in the morning. Core month over month is the number that is the most important, but it's not always the number that's the most important for the algorithms, and I'll explain that here in just a second. But last month, core month over month came in at 0.4%. This month, for February, you're expecting 0.3%. Now, here's the deal. Last month, people said core was high because one-time first of the year price increases, that's what companies do. And they chalked it up to that. That inflation's not rebounding. It's just the one-off, the one-time price increase. Now, that's okay, because that if that's all it was, great. We're in better shape than we thought. If CPI comes in at 0.3%, fantastic. If the estimates are true, awesome. But if we come in at 0.4%, the same as last month, or God forbid 0.5%, that's going to throw that theory completely out the window. The market participants are going to start saying the Fed's not cutting rates at all. The question may become, not is the Fed going to cut rates, but is the Fed going to raise rates? That could be the dilemma that we are faced with tomorrow. Now, do I think that's going to happen? Probably not. I think we're probably going to come in at 0.3%. But there's a chance that we don't. Now, core year over year is expected to fall from 3.9% last month to 3.7%. Inflation month over month on your headline is expected to increase to 0.4% from 0.3% last month, and year over year headline is expected to be the same at 3.1%. It seems like year over year headline and year over year month over month are the things that really hit like CNBC and the news wires. The algorithms trade off of this a lot. So I think that could be a little bit more important than people actually give it credit for. And if headline is rising, that tends to lead into core as well. So I think it's kind of like last CPI report. If we come in line with expectations, that's okay. That's good, right? Plus or minus 0.5% up or down, that's okay. If you come in at 0.4, you're at least going to be down 0.5% in my personal opinion. If you come in at 0.5%, that's where you open up the floodgates of possibilities of maybe we get Fed hikes from here, right? Maybe they're not going to cut rates at all. Maybe we might get some hikes. Maybe this will ultimately lead into stagflation. There's so many, the jack in the box, the can of worms, whatever metaphors you want to put on this, get opened if you come in higher than 0.4% tomorrow. But again, I don't think that's possible. It's a possibility. Or I don't think that's probable. It is definitely a possibility. And that could lead to 2 to 5% downside tomorrow. Yes, 5% downside could happen if inflation does spike another 0.5%. That's a whole nother can of worms if inflation goes up again on a month over month basis. So I think it's pretty straightforward in that sense. And tomorrow as well at 1 p.m. Eastern Standard Time, you do have a 10-year bond auction considering CPI. You really want to see how that demand comes in. The lower, the better for that 10-year treasury. Now, a couple different warning signs that I've really noticed with CPI specifically coming out is gold. Gold is known for what? What's gold known for? Well, it's known for being a store of value. It's known as being an inflation hedge. It's known as kind of a real asset. What's been happening to gold is the thing is going parabolic recently. Heading into this inflation report, gold has started to see some really big days, starting really on March 1st, which today is March 11th. So 7 trading days or so, gold has been basically going straight up. It's had green days every single day since March 1st. And I've never seen the RSI this strong in gold. The RSI looks like SMCI did. Gold has an RSI of 83. This is a very strong indication that we may get a hotter than expected CPI report. If there was anything I could point to, it's probably this recent rally in gold. Really on 2 different fronts, because gold is seen as a hedge to inflation. So that would make sense. Gold goes up, maybe inflation is going to come in hot. It's a hedge to inflation. On the other side, it's seen as a safe haven asset. So if inflation were to rise, other assets would likely sell off. And, people like to put their money in gold when there's fear out there. Tesla stock specifically, here in after hours, Tesla is at $178.13 per share. You are above this uptrending line here, which is great news. This line was at about $7.70 or so. You're above that. You're above $178 per share. So that was actually great that we did see this bounce here in after hours, because you were barely above this line when you close regular trading. To get a little bit higher than that in after hours was great news. Now, I think it's pretty straightforward for Tesla as well. If CPI comes in hot, your interest rate sensitive names are going to get whacked. Tesla could fall big time depending on how that CPI report comes out. If it comes in line with estimates, then I think Fed rate cuts are still on. I think things are good in interest rate sensitive names. Surprisingly, what I could see happen is CPI comes in line with expectations. Big tech sells off. AI stocks, semiconductors sell off. But Tesla, small and mid cap stocks can actually do very well as that market cap leaves big tech, heads into other areas of the markets, as it looks like Fed rate cuts are still in play. Now, that's honestly what I'm expecting. That's my assumption. I do think CPI is going to come in roughly in line with estimates, but could I be wrong? Could CPI come in hot and everything sells off? Sure, but my base case assumption at this point would be we probably rally in Tesla stock tomorrow, whereas semiconductors, AI, and parts of big tech sell off. Now, Nick Timmerhouse, the day before CPI comes out, always puts these charts out there, and I'll repost it right now, from different banks and their expectations for CPI. If you guys would like to see this, then go ahead and follow the X account. It's Michael Tyler over there. You can see it where my cursor is. Now, he says all eyes are on the February CPI this week. Wall Street forecasters expect the core CPI index rose 0.3%, lowering the 12-month rate to 3.7% from 3.9% in January. They see the headline index up 0.4% in February due to higher energy prices, leaving the 12-month rate at 3.1%. So here you have it. Bank of America, Barclays, Citigroup, Deutsche Bank, Goldman Sachs, JP Morgan, Morgan Stanley, Nomura, TD Securities, and UBS, they all expect headline CPI to be 0.4% or higher on a month-over-month basis. And keep in mind, they round these numbers, okay? So, for an example, Citigroup is at 0.46%. That's going to get round to 0.5%. Barclays, 0.47%. That's round to 5%. Nomura is at 0.47 and UBS is 0.47. That would get rounded to 0.5%. Then you have the lower guys like Deutsche, JP Morgan, Morgan Stanley, TD Securities at 0.41 or 0.4%. Goldman Sachs is at 0.44%. They tend to be some of the more accurate estimates that we get. So if that's true, you would get rounded down to 0.4. CPI in the headline is expected roughly at about 3.1% by all of these. Some are a little bit higher, but that's not really too important. Now, on your core CPI, UBS is the standout here. They're very high, at 0.39% month over month. That would get rounded to 0.4%. So if we were to, in theory, come in at like 0.46%, we would get rounded to 0.5%. Nobody's expecting that. That would be 2 or 3% standard deviation move compared to what's expected. That would be kind of like a gray swan event in our markets if the CPI number came in that high. Now UBS is expecting 0.4%, so roughly it would get rounded, so that would be high as well. And Nomura, they are expecting 0.37, so that would also get rounded to 0.4. Everyone else, TD Securities 0.31, Morgan Stanley 0.27, JP Morgan 0.28, Goldman Sachs 0.32, Deutsche Bank 0.30, Citigroup 0.33, Barclays 0.33, and Bank of America is 0.31. Everyone else besides UBS and Nomura is expecting CPI will get essentially rounded to 0.3. Only 2 are expecting 0.4. So even if we do get 0.4 and it's a little bit higher than expectations, right, the same as it was last month, that's, also really not expected. So that could also be quite bad. Now, if you look at the triple Qs for an example, tomorrow could actually be a huge day on a technical basis as well. You've been in this what you would call bear flag pattern, right? Where you've been, Tesla just experienced this. If we pull this up on Tesla, it looks like this. You kind of trade in a channel to the upside, and then if you break to the downside, you can break huge. Well, same thing's going on here for the NASDAQ. You're in this bear flag channel. You're starting to fall lower. If you get a bad CPI report tomorrow, you could break under this channel line and set yourself up for a lot more downside. The break of this line would be if the NASDAQ falls about 1% tomorrow. Maybe a little bit less than that, but roughly call it 0.6 to 1%. You're going to get a break under this line, and then you set yourself up for a lot more downside, potentially down to that 100-day moving average at about $403 on the triple Qs. 50-day moving average is down here at $424 per share for the triple Qs. I don't think you're set up in an optimal position here. Now, the SPY also looks the same. I don't have this bear flag actually, charted already, but it's literally the same exact situation here. So with that being said, let me know what you think about this information down below in the comment section. What is your opinion tomorrow for Tesla, for ARM, for semiconductors, and well, CPI and the broader markets? If you guys want to come trade with us live in real time, check out that link down below in the description of this video. In the meantime, hit the like button, subscribe to the channel, and follow the X account, Michael Tyler, over there as well. You guys have a fantastic rest of your day, and I will see you in the next one.